In just the past 3 years, you can see that Nike stock has lost around 50% of its value. That's quite a haircut, just going down, 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 getting pummeled. And yet you could see some value-oriented funds like the Norway Sovereign Wealth Fund, Norges Bank, buying over $1 billion position. Bill Ackman's Pershing Square, buying over a $1 billion position, 1.4, making it over 10% of his portfolio. You could also see another value-oriented shop, Capital World, buying nearly a $2 billion position. So in this video, I'm going to walk you through what I suspect these value-oriented funds see, why they're potentially buying these billion-dollar stakes now, why the stock continues to get pummeled, and my own personal take, thinking about Nike, in the years ahead. If you enjoy educational investment content, I do appreciate you hitting that thumbs up, hit that subscribe button. I apologize if my voice sounds a little funky. I'm fighting a little bit of a head cold. And so the first step is to analyze the income statement. And what I'm going to try to do here is sort of show you almost like a case study, in that if you look at an income statement within 30 seconds to a minute, you can quickly understand what's going on with this business. You could quickly see sort of the core narrative. No matter what management tells you, the numbers speak a lot to the truth. And the truth is 9% decline in revenue for the most recent quarter and 9% drop for their year-to-date results. That in and of itself is a red flag, because this is an industry. You're talking about shoes, you're talking about apparel, you're talking about a brand. And so if you're saying the underlying industry should be growing, let's say mid to low single digits, and they're declining by 9%, that's a red flag that they are losing market share. And in this video, we're going to talk about some of the other players that they are definitively losing market share to, and possibly why. So that's the very first data point, but it doesn't stop there. The next data point is you see their gross margins and their gross profit declined by about 16%. So not only were their sales weak, but they had to up the promotions, up the discounts to move the inventory. So their prior bets on the goods and brands that would resonate with consumers completely missed the mark. And that's why you've seen a change in management, new CEO come in. And this is as I've already called out, a big red flag, not only in that the sales are weak, but their gross profits are plummeting, nearly 16% or 16% in the most recent quarter. So what are they doing from a cost perspective? They're investing in terms of stabilizing the business, getting them on the right foot, where you could see their actual demand creation expense. So thinking about the marketing, that actually went up 8%. So obviously this is going to have a huge impact on profitability if your gross profits are declining by 16% and you're increasingly investing in the business. And then their overhead expenses, the people, declined by about 13%. So not able to keep up with the 16% drop. That does translate into just a huge plummet in underlying profitability. And you can see around a 30% drop in earnings so far year to date, and also during the most recent quarter. This is a very tough number to swallow. And frankly, if it weren't the Nike brand, I suspect that the stock would be down a lot further on these results, because normally if a company posts a 30% drop, if it just doesn't have this incredible brand, then it starts trading at, I'd argue, a single digit type of multiple, because then folks wonder, are you really going to be around in a few years? But that's not the case with Nike. Nike, clearly, investors and a lot of people still believe that this business will recover and it'll be stronger and bigger in the future. Another key point from looking at this income statement, they're continuing to buy back shares to a small degree. And this is one point that I don't care for, which is that they're upping their dividend, the amount that they're returning to shareholders. Frankly, in this environment where your underlying sales and your profitability is just collapsing, I think saying, hey, we're going to pay more of a dividend, all things are good, it's the wrong signal to send, in my opinion. What I would do is keep the dividend stable and say, maybe we're in a position where the stock price will really plummet, and we'd rather have that cash as dry powder for, share repurchases or future partnerships that might really drive growth in the future. That's how at least I would think about it. And you could see they're losing market share on a broad-based global perspective. This isn't just one market like China shutting them off. This is being shut down around the world. North America footwear down 9%. Europe, Middle East, and Africa down around 11%. Greater China, 17%. Asia Pacific and Latin America down 12%. So their apparel brand, including, their footwear and their Converse brand, Converse down 18%. This is just a brutal period where they are rapidly losing market share around the world. And so who are they losing market share to? One of which, I'm going to look at the public companies because their data is available, one of which is Deckers, and they own the UGG brand as well as Hoka, the Hoka running shoes. Their Hoka shoes grew by 24% in the most recent quarter. That suggests these running shoes, they're resonating with consumers. UGG brand, I'd say, is sort of a lifestyle brand. It's not really going toe to toe with Nike. Maybe it is, but it's really the Hoka that I would say is chipping away market share in terms of the running exposure that Nike historically had. Then you also have On Holdings. So this is a premium. This is more of a luxury brand that's growing very quickly, growing around 30% for the most recent year, over 30% in the most recent quarter. Very high direct-to-consumer online penetration rate, around 50% of their sales. And so this is, once again, a premium, athleisure, athletic driven shoe that's clearly taking market share from Nike, where folks say, hey, maybe I want to signal that, I can afford these really nice shoes. And it's instead of Nike, which has sort of diluted the brand perhaps over time, maybe it's On Holdings or maybe it's Hoka over time that folks are going to. I would say On is more of the premium. And then more of the lifestyle, just everyday, shoes, Skechers, SKX, they're also growing relative to Nike. They recently posted around 12% growth, 13% for the most recent quarter, and they're growing broad-based, wholesale as well as direct-to-consumer. So the challenges Nike face, I would say, really do reflect that consumers don't like the previous bets that they've been making over the past year or two, where you can see it's not just one competitor. And also, I believe New Balance, that's privately held. Supposedly, they've been rapidly taking market share as well. So from a running perspective and from a lifestyle perspective, there's a lot of brands that are just growing much faster than Nike. That is something that investors should think about. So what is Nike doing to sort of reverse this trend? One of which is new marketing campaigns. They saw their first Super Bowl ad in the last 27 years. This brand is the "You Can't Win, So Win." That's the marketing scheme, the "So Win" campaign. Personally, I think this marketing campaign is dumb. They didn't consult me, but then again, I'm not running around wearing my Nikes. I'd love to hear your take on this new marketing campaign. It doesn't speak to me. I'm curious if other people are like, oh yeah, this is a cultural moment. This is epic. This is like the next Jordan. I just don't see it. I think they're still missing the mark personally. Next up, they are sort of looking to blitz the brand awareness domination. Every single venue where a lot of eyeballs will be there, whether or not it's the NBA or the NFL, you're going to be seeing someone wearing the shoes. And I'd say that is their biggest, strength, their asset is this brand where at these sporting events, you just see so many people wearing the shoes that it is enough of the cultural zeitgeist. You get it in your head that, oh, well, this famous athlete's wearing it, therefore I'm going to buy it. I want to buy my Nikes. This famous performer singing and dancing, doing a little jig, and he's wearing, his Nike songs. Therefore, I want to, buy, have my Nikes as well. So I think there's that element, and I don't think that's completely disappeared because they still have the budget to effectively buy these people to wear their goods. And I think that hasn't changed, and you're going to see that with athletes, and this is why I don't think it's trading at a rock bottom multiple. So what are my thoughts as we look at Nike? First of all, as always, this is not financial advice. I don't own shares in Nike. I'm sort of exploring the bull case, why some of these smart investors have been buying recently. Also, quick plug, recently Henrik, a premium member of the Unrivaled Investing community, shared the following. This is a direct quote. "Subscribing to your platform is the best financial decision I've made in my life. And also, thank you for letting us lock in the rate for the subscription." This follows Sam, who recently said, "Daniel, just re-up my annual subscription after 1 year of being in the community. The subscription has paid for itself many times over. If you're looking for compelling ideas, come check out Unrivaled Investing. I will be raising the rate for the premium tier later this year. So now is the time to lock it in." When I think about Nike, I have a very simple checklist. You will see this often in my videos: aligned management, compelling valuation, obvious growth potential, no blow up risks, and a win-win setup. When I look at this, it's a very straightforward list. However, 90% of the companies that, come across this list, I'd say fail. And, you still have the Phil Knight, family background, still has, a strong influence. If you haven't read Shoe Dog, I highly recommend it because, it did reflect sort of Phil Knight's tenacity. And I think his family still has, strong influence over the company. But it did reflect, thinking about what he did is he found this niche in terms of running and really plowed ahead with it and was able to beat out Puma and Adidas, I think. And that's what Phil Knight did, selling shoes from the back of his car. But when I think about this checklist, the one that really jumps out at me as not passing is this obvious growth potential, where I prefer something where management can say, yeah, here's why definitively this is going to be, up so much in the years ahead, or why it's just the valuation is just so compelling that it just jumps off the page. And I think looking at Nike, I'm not able to see something that does it for me. Now, for some billion-dollar funds that have to deploy capital, they might go, yeah, this is sort of a reasonable bet to make. So not surprising to see the Bill Ackmans of the world make it 10% plus of his portfolio, because he's saying, yeah, this is a world-class brand. It's probably durable. It's probably going to be bigger and stronger in 5 to 10 years from now, probably. So maybe it makes sense to buy, on sale, on clearance when it's down 50%. And so what are some of the growth, trajectories, some attack vectors that they're considering? They have announced a partnership with Kim Kardashian's Skims brand. I think they've yet to announce the products themselves and should come out later this spring. But, talking about wanting to be body obsessed and you want to look good and feel good, taking sort of the edgy, the sexy aspects of Skims and the Kim Kardashian brand, marrying it with Nike, maybe you could have some sort of joint venture or partnership that really does result in uptick in growth. Now, I suspect this would be a lower margins for them because you would have that share, but we'll see. It's unclear exactly how that plays out. Another growth, attack vector, launching new shoes to directly address the losses to New Balance and On Running and Hoka, talking about the Nike Pegasus premiums, which, they're talking about supercharges responsive cushioning with a triple stack of our most powerful running technologies. So they're trying to say, yeah, the Hoka shoes that are supposed to be super comfortable and the On Running shoes that are supposed to be super comfortable, yeah, we're putting up our own, and that will be coming to the marketplace soon as well. So there are clear growth, vectors that could reinvigorate the business. That said, in the immediate term, they are still facing very real challenges. Their next quarter, they're still expecting to see a significant revenue decline, even worse than their most recent quarter. Maybe this is because you have new management trying to temper Wall Street's expectations, but either way, this is a tough reset. This is a tough pill to swallow. Talking about a mid-teens type of revenue decline. So maybe they post only 10% and that beats expectations. So you start getting into a, type of beat expectations cadence that could result in the stock, starting to reverse the trend. But they're still expecting not only a tough decline, but also a huge margin decline as well, around 4 to 5% decline in margins. And then you also do have the uncertainty around, tariffs around China and Mexico and how that will impact the business in the year ahead. So still huge negative despite potential attack vectors that could grow the business. Personally, as I think about the valuation around $100 billion market cap, it's just tough for me. I don't have super high conviction to say, oh yeah, definitively 5 years from now, this business is for sure going to be much, much bigger. And if you assume just sort of flat over the next 5 years and assume that the multiple comes down to, let's say, 15 times and their margins are sort of around 10%, this is I'd say a low case scenario. This assumes that management does not succeed with any of their turnaround initiatives. Then in that case, you're still talking about roughly another 50% decline. So that doesn't strike me as just super compelling. Now, you could argue I'm just being too draconian. And clearly, the value investors that have recently started buying are saying, yeah, management will not accept this type of scenario. They're clearly betting on a 5 to 10% organic growth scenario, in which case you do see, maybe the multiple stabilize around where it historically bottomed, around 20 times maybe. And then if you're able to get something like that, then you can get something like 100% type of return, especially if you're able to get back into that 10% type of annual growth. For me personally, that's just too hard. Because especially looking at it, it's still nowhere near any sort of like deep value multiple. This isn't trading at like a 6 times free cash flow where you're like, is this brand even going to be around in a few years from now? And so that does reflect that Wall Street does still strongly believe that this business is going to be bigger and will be around 5-10 years from now. So the key aspects of this business, which is that athletes, performers, they're still going to be wearing it, and they're still going to have the budget to bribe these, to encourage them to wear it at these events, and in these different sporting arenas. And so you do have that dynamic. Personally, too tough for me. But I think it is kind of interesting. One company, shoe company that I haven't talked about, I don't own, but I'm tempted to explore, is just sort of as an example, is the Crocs brand, which also owns Hey Dudes. I think it may have done a deal with this actress Sweeney, I think is her name, where the appeal there is that the Wall Street and investor confidence in the durability in this business 5 to 10 years from now is much lower. And so therefore the earnings multiple that they're assigning Crocs based on their current earnings, so that's CROX, is only around 6 to 7 times earnings. So it is sort of an interesting case study because, as you look at Nike's nowhere near that, because Wall Street's saying, despite this decline, we still believe in the durability. So I would say from a psychological perspective, you haven't really gotten to a true, like, this is just awful, puke it up sort of moment with Nike. You've gotten to a point where investors are just frustrated, down 50%. And it's not near that sort of Crocs sort of valuation of 6 times where people are going, I don't, even though Crocs is growing slightly faster than Nike. So I hope this video talking about Nike, sort of the challenges they face, the prospects of a turnaround, have been helpful for you. If they succeed, it is easy to see. If they're able to succeed with a 5 to 10% type of growth, turnaround in the years ahead, it is easy to see 100% type of upside from here. Personally, I just would rather bet on things that are a little easier, where I don't have to say, oh yeah, there's a, this turnaround may or may not happen. I'd rather, have something where management says, here's the rinse and repeat playbook for, we grew 15% this year and why we think we're going to keep growing 15% for the next few years, because, this is why our product is unrivaled and this is the market that we're tapping into. So that's just my personal journey. I could understand though why other value investors have started picking up shares. I hope this video has been helpful for you. Thanks so much for watching Unrivaled Investing.